Welcome back, everyone. We're diving into something pretty exciting today, creating a lifetime of passive income through dividend stocks.
Ooh, lifetime passive income sounds nice.
Right. We'll see how realistic that is.
All right.
We're using a Motley Fool article as our guide today. It came out February 8th, 2025, and it's called Want Decades of Passive Income. 2 top dividend stocks to buy in 2025 and hold forever.
I like the title. Very straightforward.
Yeah, and picture this. Just sipping your coffee, checking your investment account, and bam, you've got a nice little deposit just from owning some stocks.
That's a pretty appealing image. That's the power of passive income.
Exactly. And today we're going to find out if these 2 companies they talk about can actually make that dream a reality.
Let's get to it.
So first, can you just break down dividends quickly? How do they play into this whole passive income thing?
Sure. So dividends basically are a way for companies to share their profits directly with their shareholders. It's like getting a little piece of the pie just for owning a piece of the company.
Yeah. Makes sense. But, the article is claiming these stocks could pay you for the rest of your life. That seems a little, too good to be true.
Yeah, you got to be cautious for sure. No investment is completely risk-free.
What's the catch?
Well, the thing about dividends, the really attractive part, is that they can provide this steady income stream. But at the same time, your investment can potentially be growing.
So you're getting paid, and it could grow.
Yeah, you can think of it like this. You get those dividends, reinvest them to buy even more shares, and then those new shares create even more dividend.
Like a snowball effect.
It's called compounding, and it can be incredibly powerful over the long term. Plus, dividends can help you stay ahead of inflation, which is a big deal. Especially these days.
Yeah, that's true. So it's not just about getting a check, it's about building wealth over time.
Exactly.
Okay, so let's get to these, what they call forever stocks. The first one is Waste Management, ticker symbol WM.
Waste Management.
Okay.
Okay.
Yeah, maybe not the most exciting business to think about, but the article makes them sound like a dividend powerhouse.
Waste Management is interesting because they're a great example of what we call a wide moat company.
A wide moat company.
Think of it like a castle. The wider the moat, the harder it is to attack. In business terms, it means they have a strong competitive advantage. And in Waste Management's case, their moat is, well, trash.
Because everyone produces trash.
Everyone produces trash.
Yeah.
It doesn't matter what the economy is doing, people need their garbage collected. This gives them a super stable, recession-resistant business model.
Can't argue with that. You can't just decide to stop taking out the trash. And the article mentioned they've actually increased their dividend for, get this, 22 years straight.
Impressive, right?
Super impressive. What makes them so consistent?
Well, a couple things. Firstly, they're the dominant player in North America. They've got this huge network of landfills and transfer stations, so it's tough for competitors to even get a foothold.
Makes sense.
And they've also been making some savvy acquisitions. Like recently they bought Stericycle, which is a big name in medical waste disposal.
I didn't know that.
Yeah, it's a smart move. They're expanding their reach and strengthening their cash flow, which is essential for paying out those consistent dividends.
So they're the kings of trash, and they just keep growing their kingdom.
Exactly.
What about their dividend yield, though, like right now?
At the moment, it's hovering around 1.5%.
Okay.
It's not the flashiest number out there, but you got to consider the consistency. Their track record and potential for future growth makes them a really solid choice for long-term passive income seekers.
It sounds like a slow and steady kind of investment, like a garbage truck, just reliably on its route.
Yep, a good analogy.
All right, let's switch gears now. Let's talk about a company that's probably a lot more familiar to most people, AT&T, ticker symbol T.
AT&T, yeah, everyone knows them.
Their dividend yield is a lot more eye-catching. It's currently sitting at 4.5%.
Yeah, it's a juicy yield.
Yeah.
AT&T is what you call a classic blue chip company. They've got this long history of paying dividends, and right now, what's really working in their favor is their focus on bundled services.
Bundled services, so like internet and phone.
Exactly. They're combining wireless and broadband internet, and it's attracting a lot of customers who want that convenience and value.
The article actually highlighted some pretty impressive subscriber numbers.
Yeah, their growth has been strong.
They said AT&T added almost 500,000 new postpaid phone subscribers last quarter and over 300,000 new fiber internet customers.
Those are solid numbers.
And get this, they've added at least 200,000 broadband subscribers every quarter for the past 20 quarters.
Wow, that's a testament to the effectiveness of their strategy.
It really is.
All those new customers mean more revenue and cash flow, and AT&T is using that to reward shareholders in 2 ways: dividends and share buybacks.
Okay.
In fact, they've committed to returning a massive $40 billion to shareholders over the next 3 years through a combination of these methods.
$40 billion. That's a lot of money. But what are share buybacks exactly, and why would a company choose to do that?
So when a company buys back its own shares, they're essentially reducing the number of shares that are out there.
Okay.
And when that happens, the earnings per share go up, which can boost the value of the remaining shares. So it's a way of directly giving value back to the shareholders.
Okay, I see. But wouldn't it be better if they just took that money and reinvested it back into the business?
Well, it depends. There are pros and cons to both, right?
Right.
Like if they reinvest those profits, it could lead to future growth and down the road, maybe even bigger dividends. But it really boils down to the company's strategy and their potential for growth.
So it's like, do they give us a piece of the pie now or trying to make a bigger pie later?
Yeah, that's a good way to think about it.
The article also mentioned something about AT&T having a forward-looking price-to-earnings ratio. They called it a PE ratio, and it's under 11. What does that even mean?
So the PE ratio, it's basically a way to measure how much investors are willing to pay for each dollar of the company's earnings. A lower PE ratio, like what AT&T has, can suggest that the stock is undervalued compared to its earnings potential. It's something that investors, especially value investors, they look at pretty closely.
So a low PE ratio could mean it's a good deal.
Potentially, yeah.
Interesting. So we've covered a lot on Waste Management and AT&T. They both seem to have some strong points for dividend stocks. But what are your thoughts if you had to compare the two? What would you say?
Well, they kind of appeal to different types of investors, I think.
Oh, so?
Waste Management, they're more like the tortoise, slow and steady, delivering that consistent dividend growth. Plus, they're in a recession-resistant industry, so that's a big plus for some people.
Right.
So it's a good fit for someone who's thinking long-term, who values stability and knowing what to expect. Then you've got AT&T, more like the hare. They've got that higher yield now, and they're actively returning value to shareholders.
Makes sense.
That might be more appealing to someone who wants that immediate income.
Right.
Or who's looking for potentially undervalued stocks.
So slow and steady versus high yield. That's an interesting way to put it. But I guess with anything in the stock market, nothing is ever guaranteed.
Right.
Yeah.
You always have to remember that past performance doesn't guarantee future returns, and every investment comes with some level of risk.
Yeah, good point.
Always. Always do your own research. Make sure you understand what you're investing in before you jump in.
Good advice. Speaking of research, I was actually looking into waste management a little more, and I found something pretty interesting. They're making big investments in renewable natural gas production.
Oh, yeah?
Yeah. They're actually capturing methane gas from the decomposing waste in their landfills and turning it into clean energy.
That's fantastic.
Yeah.
It's good for the environment and creates a whole new revenue stream for them. It positions them as leaders in the renewable energy space.
It's like turning trash into treasure. Okay, so we've talked a lot about these two companies, but I'm curious, how do dividend stocks in general fit into a broader investment portfolio?
Well, they can be a valuable part of any diversified portfolio. Especially as you get closer to retirement, they can provide that steady income stream. And they can also help cushion your portfolio during times when the market is volatile.
Because they're more stable.
Exactly. So when you're watching those high-growth tech stocks taking a nosedive, those consistent dividend payments can really provide some peace of mind.
So it's not just about chasing the highest possible yield.
No, it's about balance. Finding that balance between growth and income that aligns with your financial goals and how much risk you're comfortable with.
This deep dive has been really interesting. Waste Management and AT&T, it seems like they could both be good options for investors who are looking for dividends. But before we wrap things up, I've got one more question for you. What if you could design, your ideal passive income stream? What would that look like? And what could someone do, today, to start making that happen?
That's a great question. It all comes down to figuring out what your goals are for passive income and then seeing how those fit in with your lifestyle.
Okay.
Do you want to be totally hands-off? Or would you be willing to put in some work up front to, maybe get bigger returns down the road?
I see.
And what are your resources like? Do you have a bunch of money to invest? Or are you starting small and building gradually?
So there's no one right answer for everyone.
Exactly. Passive income is really cool because you can tailor it to your specific needs and what you're interested in. Let's say you love real estate.
Yeah.
Maybe you buy a rental property. Or if you enjoy writing, maybe creating and selling an ebook is more your style.
It's about finding what you're passionate about and finding a way to make money from it.
Exactly. Passion and profit.
Right.
But you got to remember, building this kind of income, it takes time.
Okay.
It's not a get-rich-quick scheme. You have to be consistent.
Got it.
Whether it's researching different implements, developing a new skill, or building an online following.
So it's a marathon, not a sprint.
That's a great way to put it. And sometimes the hardest part is just getting started.
Right.
But once you do, even small steps like investing a little bit each month can make a huge difference over time.
Wow. This has been a really informative deep dive. We learned a lot about dividend stocks. Those two companies, Waste Management and AT&T, seem promising. And we even touched on all sorts of other passive income ideas. Any last words of wisdom for our listeners before we go as they start exploring this for themselves?
I think the key is to just stay curious. Keep learning, keep exploring different opportunities. Passive income is always evolving, so it's important to stay informed and, be willing to adapt your strategies. And remember, the best investment you can ever make is in yourself. Invest in your own financial education.
Couldn't agree more. Thanks so much for joining us on this deep dive. We hope this has given everyone some great ideas and some inspiration to build a more financially secure future.
And until next time, keep those dividends flowing and those passive income streams growing.